It is Friday. We are live on LinkedIn and YouTube, and ready to begin here. So let me grab my stuff here. All right, let's begin. Hello, Smart Money Tree podcast listeners. Welcome to this week's show. My name is Kirk Chisholm, and I will be your host. So today I'm joined with my good friend Tim. How you doing today, Tim?
Good. How are you today, Kirk?
I'm doing great. I'm doing great. It is Friday and ready for the weekend and all the fun that entails. Hopefully, there's some fun involved in there. But
Yeah.
um, glad to have you back in the show. And yeah,
Thanks
what
for
do you
having
got?
me.
What do you got going on this week, Tim?
Yeah, so it's obviously been a busy week, trying to focus on helping out clients and obviously ideally bringing in some new clients as well. But actually navigating around some of the things that I think we're probably going to get into here, which is lots of questions popping up about, the market and recessions. In fact, I was just looking right before we jumped in about three different articles on marketwatch.com, all of them saying something different about whether or not a recession is coming. And so obviously that's been giving the market a little bit of jitters. And I mean, you're dealing with it too, still dealing with, the Federal Reserve. Everybody and their brother from the Federal Reserve is coming out with comments this week.
Yeah, and I think it's important to kind of take a pause here to kind of talk about some concepts before we begin, because there's a lot of stuff we're going to go through today. We're going to share some charts as we usually do. So those of you on audio, you can check those charts out on our website at moneytreepodcast.com. You can also check out these shows live on LinkedIn and YouTube if you want to go check those out. Then you can see our pretty faces, or you could just turn the video off if you don't like that sort of thing. Anyway, so let's kind of dive right in. So I've got a chart here I want to share, and let me just share this up. All right, so I got a chart I want to share, and I want to kind of describe what you're looking at here. This is a chart of the S&P 500 performance over the last basically 2.5 years, almost 3 years. All right, so
Is that
looking at
volume
this.
on the bottom?
Yep, volume's on the bottom. We're not going to make it too complex, Tim. I know, I know you want to. You love
I'm
the
looking at
detail.
it. I'm looking at it like a dog drooling.
Yeah, Tim can't wait to talk about all the detail here. So, but I want to point this out for a few reasons. So we brought this chart to really show this is basically like 2020 to 2023. It's about 3 years, and what it shows is the market going pretty much straight up for for 2020, 21, and then peaking right at the end of 21, and then going down for 22. I point this out because I think when people hear numbers, and this is the concept I want to teach today. When people are hearing numbers, they're like Dow's at all-time highs, S&P, Nasdaq all-time highs, 52-week highs. Whatever people say, it's meant to elicit an emotional reaction out of you, right? Oh, the S&P is at 52-week highs. Who cares? Right? Does it matter to you? I don't know. Right? Should it? Doesn't it? Depends on what else is going on. Now, if that is in context, the market's selling off, 60%, you're like, wow, it's at all-time high. It's at like 52-week highs. Well, it's great that it's off the low point, but you still are down 60%. So it may not be such a good thing. And what I think people don't realize is you look at this chart, like last year, huge sell-off. This is the S&P. It could have been the Nasdaq or the Dow, and I'll show some other examples in a bit. But look at the S&P, you'd say, well, pretty much it's gone sideways for the last two years, right? It's the same place it was in July of 2021, and same place it's been in April of 22, and pretty close to where it's been, August, September of 2022. So it's basically gone sideways. So it's gone a lot of places. It's gone up, it's gone down. But if you look at it in the context of a wider scope of time, it's really gone sideways. So if you're an indexer, there are plenty of people out there who are indexers, and they teach their own with their approach. But if you're an indexer, you're probably saying, why am I not making money this year? Why am I not up 12% a year or 20% a year, whatever your expectations are? Why am I not up that much every single year? Well, it's like, well, you're indexing based on the index, which means you're going to get the performance of the index. So if you look at the last 12 months, you pretty much went sideways, right? You made almost no returns over that period. And, the market has gone up from the low, but let's look at this. January 1st, 23 was kind of a low point in this range. Not the lowest, that was around October, but it was a low point of the range. So anything above that is a positive return. Now it looks great, but if you've been indexing for years, it doesn't really matter. So you're going sideways, right? You're still down from the peak, and we're still, what is this, 10%, more than 10% away from the peak, maybe like 13% away from the peak. That's still a big jump from where we are now, and I think a lot of people would argue that pretty much we're a lot higher than we should be. So if you really look at the range of what is, I would argue, kind of more reasonable, the range was around 420 on this chart. Right now at 433. So anything above 420 means that we've broken out of the range and things are more bullish, right? And that's based on this chart, right? You say, well, things are bullish because it's above the range. I would agree with that. Things are bullish when they're above the range. However, if they go back into the range, that's bearish. That means that the market didn't have what it took to continue higher, and it's back to range bound, or some people consider that bearish. But I would just say you're back in the range, which means you're in the sloppy middle. And so I think what you need to keep in mind is no matter what people tell you, they're going to put it in a certain context of 52-week highs, all-time highs, 1 month highs. They're going to probably, if you're watching CNBC or the other media, they're going to say, oh, well, the NASDAQ is broken out. It's up like 50% this year. Well, it was down 50% last year. You have to put things in context for where things are. Because the best returns, we talk about in the show, there's one of the Wall Street illusions out there. Some of the best returns come off the low, which of course only matter if you bought at the low, and nobody does. So it doesn't really matter to you because you've owned it all the way down. So owning it all the way up doesn't really mean anything. But if you bought at the low, it's a great return. But people don't do that. So the point is if you look at one of the Wall Street illusions people show you, if you missed the 10 best days in the market, you would have missed out on 10% annualized returns. What they don't tell you is if you missed the 10 worst days in the market, you would have missed out on 20% annualized returns. You would have done much better. And what they don't tell you is statistically, the best returns come off the lows. So the biggest returning days are usually off of low periods where it just rockets up like 5% or whatever it is in a day, because the last week it was down 15%. And the point is if you don't understand the context of what they're telling you, it's probably meant to deceive you. And it's probably meant to elicit a response, usually fear or greed, which is what the media tries to do. Usually fear sells better, but greed works in Wall Street as well. So that's the concept I wanted to kind of talk about here. Any thoughts, Tim? Because without getting too much in the weeds here.
Yeah, no, I mean, there's a ton I want to say about this chart and what you were just saying. So the question I wrote down, why don't I get this return every year? Right? So this is a conversation we have with clients, not all the time, but in years like last year, certainly we do, which is you can get the same return every year by buying a bond. And actually, that's not even true, because as interest rates fluctuate, the value of the bond will go up or down as well. So unless you own like a CD or something with some kind of a lock-in period on it, nothing's going to move in one single direction, right? If the stock market went up 8% every single year, nobody would ever invest in anything else ever again. So it just isn't going to happen that way. And that is absolutely proven out by this chart. Even in the straight line up, since I assume your bottom there is the COVID crash.
It's actually after. So it's a little bit after. This is a 3-year chart. So
somewhere around March or April of 2020.
Yeah.
Okay. So even in that straight line up, look at all of the little dips, right? So the market just doesn't move in one direction. It just doesn't happen that way. And even now in 2022, when everybody was feeling so pessimistic about the market, you've got periods where the market is shooting up, and it gets to a little bit of what I think you were kind of alluding to. Maybe not, I don't want to put words in your mouth, but you wind up with a little bit of a head fake, and people start doubting themselves, which is why timing the market is so difficult, because it's easy to lose faith in what you're doing when the market moves in a different direction from the call that you were making. And now here on the way up in 2023, you're getting these dips as well, which I think is the reason that you named this podcast what you named it, which is it's a crazy new bull market, or is it? Because that's what we're going through right now. This is the worst week for the S&P 500 since the quote unquote bank crisis in which we can talk about that too. I don't know if we want. I think to your point about media, right? We like to use words that get people's emotions running, and crisis is a great word that does that, whether it applies or not. But the worst week since then. So then it starts to make people question, like, well, maybe I shouldn't have been buying. But again, the market doesn't move one direction. I actually think that's a pretty compelling chart. Because you've got all last year you had lower highs and lower lows, whereas this year you're getting higher highs and higher lows, which is usually technically a good sign, but who knows. And then the other thing I was going to say that I talk about a lot in presentations that I give, as you refer to it, indexing. And it's not that we don't have the S&P 500 in our portfolio, we do, but we build other things around it, because owning the S&P 500 or talking about the S&P 500 to us is little like talking about weather on planet Earth, right? It doesn't give you a good picture. So I update these pretty much every day. So this year, the S&P 500 is up about 14%. The Dow Jones Industrial Average, which for some reason people still like to talk about a lot, is up 2%. Right? So where does that all come from? As you alluded to, the NASDAQ is up 29.5% this year. So to me, it's important to understand where the market's going, but also what's driving the market there.
Yeah, no, I think it's a great point, and I pulled up the this other chart. I extended it because Tim asked where this was, and I actually the second chart.
There you go. Okay.
I included COVID, so you could see relatively how the market has performed.
Yeah. Now, COVID, you didn't really get ups and downs.
No.
That is a sheer-faced cliff.
Yeah, and that does happen, and it's much like the NASDAQ is a sheer-faced cliff up.
Right.
And you could argue that was mainly due to NVIDIA, but I think the challenge, and we're going to get into this with one of the next charts, is, I mean, the NASDAQ looks great, but if you look at the prior year, it went from 400 down to a low of 260. That to me smells an awful like 40% drop. So the fact that it's up 20 some odd percent, that sounds great, but is it? It depends. Have you been in it since the peak? If you've been in it since the peak, you're still down. Yeah. You're still down about 10% off the peak. So I think we're bringing this up just to show the relative nature of comments.
And it's a great concept that doesn't get talked about enough, which is the asymmetry of investment returns. It's if you ask a group of people, hey, if you got $10,000 and your account goes down 50%. What return do you need to get back to $10,000? And I think most people get it, but a lot of people would be like, well, 50%. No, downside is way more painful than upside is helpful. If your account goes down 50%, it's got to go up 100% to get back to where you were. So I would agree with what you were saying earlier, and I meant to comment on this, which is you look at all of this stuff, and it does look great. But you have to consider your timeline, like over what period did you own it? And I do make the argument for people that are complaining to me that, we're losing money and the market's going down. Well, okay, but over what time period? Like the market hasn't really, quote unquote, gone down since October 12th of 2022, right? That was the bottom for the S&P 500, and we've had a pretty good run since then. So I do think there's a patience factor when people talk about these types of things, because I don't think people mind losing money as much as long as they get it back quickly. And it just doesn't happen that way. It's like, I think maybe I'm jumping ahead here, but we were going to talk a little bit about the Federal Reserve and inflation. One of my concerns is the Federal Reserve obviously they took a pause recently, but if they're talking about doing 2 more rate hikes this year, you hope that they're going to be true to their word and be very data dependent. Because when you have economies and stock markets and bond markets that are this size, they don't turn like a Chris Craft, they turn like the QE2. And so there's always going to be some kind of a lagged effect, and it's just not going to move as fast as you want it to.
Yeah, so we'll get into that in a minute. I want to bring up another chart here, which will kind of illustrate some of the challenges that we're talking about. So if you're looking at index returns, the index, you'd think, well, it's the market. It's what the market's doing. And as Tim said, the Dow is only up 2% this year. The Nasdaq's up close to 30. The S&P is up, 15, 16. Today's another down day, so I don't know what it actually is at the moment. But basically, you can look at it and say, wow, like there's such a difference. Be like, well, first of all, the Dow is 30 stocks. It's not big, and they happen to be large cap stocks. And out of those 30, I would say probably the largest are in the S&P 500. So if you look at this chart here, and it looks nice and colorful like a bag of Skittles, the way that you can interpret this is each circle is a sector. Each sector has subcircles, which are the company. So if you look at like the infotech sector, well, Apple and Microsoft combined make up 14%. If you include video, 16% of the index of the whole S&P 500. So you've got 2 companies that make up 14.2% of the index. If you have the FANG stocks, it makes up a whole 26% of the index in a handful of stocks, in like 5 or 6 stocks. That is crazy. You're investing for the index, which everybody says, well, the index is what's best. Maybe historically, and I want to put this as another kind of learning point for people today, is that just because something's happened historically, it doesn't mean it's going to continue to happen, right? So if I look at 50 years ago, you could say, well, historically, it was a great idea to, to buy and hold. And then you hit the 70s. Well, it was no longer a great idea to buy and hold. That was a really rough period to buy and hold, right? Or like the early 2000s, that was not a great time to buy and hold. Overall, it's a good strategy in a bull market, just not in a sideways market or a bear market, right? You look at Japan, their stock market went down for 22, 23 years in a row. So you pretty much lost money for over 2 decades if you were buying and holding in the Japanese stock market. Now, the Japanese stock market is not the US stock market, but I use it as an example of something that can happen. So buy and hold is not a great strategy. It can be in the right environment, which, when you have a bull market like 2009 to 2021, you had a great bull market. So buy and hold worked, but it doesn't necessarily work in a bear market. From 2000 to 2013, you had a negative return, negative like 0.05% a year return during that 13-year period. You lost 13 years if you were buying and holding. The market went up and down all over the place, but if you were buying and holding, you would have lost money for 13 years. That is not a good strategy. That is losing time. Time is the one thing you can't make more of. You can make more money, you can make more goods, you can do a lot of things, you can't make more time. So if you lose 13 years of time, that's a problem, right? So the idea is if you have environments like that, you want to find alternative strategies like Tim alluded to, like investing in bonds. Right now, you can make 5 to 5.25% U.S. Treasuries. That is not a terrible return. That's quite nice historically, right? You have virtually no risk. There's obviously risk in everything, but it's one of the lowest risks you can find. You buy like a 1-year Treasury, you're making 5%, 5.25% for a full year, and then at the end, you get all your money and you do something else with it. Versus, hey, I want to take a shot, put all my money on black, and hopefully it makes it. If not, I lose it. Or let's hope the stock market goes up. Those are not strategies, right? So we bring this up because we want to show the impact of a handful of stocks on the entire index. Apple, Microsoft, Amazon, Meta, Nvidia has been a powerhouse this year. It was up some ridiculous number in returns because people think it's the AI stock because there aren't many to choose from. So you've got these stocks that are impacting the most. So the more that happens with these stocks, the bigger impact it's going to be for the index. So you get these discrepancies in the index because value stocks haven't really gone up 15-20%. Growth stocks have, mainly in the FANG stocks. So we just point this out because it's important to keep in context what is actually going on. Now, if it was a bull market and everything, like all the stocks were going up similarly, and there was a wide breadth of performance on the upside, I'd say this is a bull market. But it's not really that way. It's really a concentrated effect in a smaller segment of stocks. And what that means is people are just like, hey, we're making money in these stocks. Let's just put all our money in there. But that's not a strategy. That's gambling. So, if you think Nvidia is going to double what it's already done this year, with what do they have, a PE of 199? Good luck to you. I think that's a pipe dream, but I'm not going to give a positive or negative Nvidia because the regulators won't like that. However, I think if you're going to buy something with a PE of 199, you should expect that you'll probably break even after 200 years. So if that's what you think, if you're going to be around for 200 years to get your money back, good luck to you. But that's basically what a PE of 200 is you got to wait 200 years to basically make your money back. So I would not look at stocks that are overly expensive right now. I'd look for things that are going to be resilient and sustainable. I do want to touch on inflation. I'll give it back to Tim here. So the next slide here, I'm going to run through a bunch of slides, and then we can kind of go back over them. So the next bunch of slides are basically based on inflation versus interest rates for a bunch of different countries. So we tend to be U.S. focused. And I always see these funny memes. They show a map of the world, and it just shows the U.S. and it just says like us, and then the rest of the world says not us, not us, not us. It's like people can't see outside the country borders. They don't know there are other countries out there. That's a very American thing to do. So I wanted to share this. So this is Canada, right? So inflation rate, policy rate are the same, but the inflation rate went up and then came down, and then the policy rate kind of is equal. Here's New Zealand. Policy rate still hasn't caught up to the inflation rate. Australia, way below the inflation rate. Eurozone, still way below. The UK, which is definitely having some inflation problems, well below. And then the US, which is actually inverse. So the policy, the Fed funds rate is above the inflation rate. Now, I kind of point these things out for this reason, and here's a kind of an aggregate of where the rates of inflation are with different countries. So I want to point this out for this reason, okay? If you look at the US, all right, you'll see that inflation peaked right around the same time that we started raising Fed funds rate. Now, if you looked at this chart, you would naturally deduce that the fact that we raised our Fed funds rate is what caused inflation to drop. Now, if you're just looking at correlations, you'd think naturally this is what happened. But if you know more of how things work, where a raising of the Fed funds rate can actually take 6 to 18 months before it even impacts the market and the economy. It can take a year or more for it to impact. So this correlation of happening at the same time is a non-starter. You should also look at the fact that it did peak and then start to drop by itself without the Fed's funds rate. So it leads you to question the fact that does the Fed funds rate really have an impact on inflation or not? Now, I raise this point not because it's not true. I raise this point to get you to think. Is it true? How do you know? How do you know if the Fed funds rate is really impacting the inflation rate or not? Now, it does for some very obvious reasons, but it should lead you to believe, because obviously the correlations don't line up if you understand that there's a delay of 18 months. And we've argued on the show that inflation rates could actually get to zero this year, oddly enough. So, but I wanted to just point these correlations out, because if you look at these different countries, I mean, especially the UK, they're a mess. I mean, their inflation is through the roof. I hear people complaining all the time, people I know, about the rate of inflation, and it's not going away. So just keep that in mind, that as you see inflation go down, the Fed is going to claim it's them. It's definitely not them. That they are not the reason that inflation is dropping. We can come back to the bullwhip effect, which we talked about on the show a while ago, which is, when you have spikes in certain directions, they tend to spike in the opposite direction. So think of it as like you hold a beach ball underwater. Like the deeper you hold it, the higher it's going to pop up, and then it hits the surface and goes down a little and up a little, and then it finally finds a balance. But that's typically what happens in this reversion to the mean concept of when things go too far in one direction, they go too far in the next, and eventually they find an equilibrium, which will probably end up being right around 5%, in my opinion. But what are your thoughts, Tim? We talked about this before the show a little bit.
Yeah. So just going back to a comment you made earlier, just because I think it's important, and I don't know if you got the chart that I sent over to you earlier, but 5.25% in a treasury, like let's put a finer point on that. 5.25% for 6 months. Like there you go. So you don't have to lock up your money in a T-bill or a note or a bond for a long period of time. You actually get a better yield. So I was just looking over at the screen. If you go out 2 years on a treasury, you're going to get like 4.96. If you go out 6 months, you're going to get a 5.30, right? So it's actually the shorter you go, the better your yield. It's almost like the less risk you take, the better the return that you get. And as you just alluded to, that's going to change someday. So you have to weigh this balance. You have to balance this. Well, I want to get the highest yield possible, but what happens if you're trying to rely on that yield or that return and you invest for 6 months, and 6 months from now, short rates have gone down, and I want to address this chart. Short rates have gone down, or the yield curve, which is what this is showing, has evened out, or maybe even someday goes back to normal again. It's weird, like how long this has lasted. The twos to tens. So basically, what everybody's looking at here is the difference between the 2-year Treasury yield and the 10-year Treasury yield, and you see a normal environment, which is most of the life of the yield curve. That's what we call it, from short to long maturities. A 10-year yield should be significantly higher than a 2-year yield, right? Because you have less certainty. You're taking, there you go, that's a nice one too. You're taking on more risk by going out further. You're taking on what's called duration or time risk. So for 10 years, I should get paid more than I should for 2 years. That's what investors usually demand. However, when you get into a situation like we're in right now, which you just alluded to, Kirk, where everybody thinks we're going into a recession, it becomes somewhat of a self-fulfilling prophecy. So everybody views the difference between the 2-year and the 10-year Treasury, when that is inverted, meaning 2-year yields are higher than 10-year yields, that is a forebearer of recession. And what it's basically saying is, I'm less certain about the present than I am about the future. I'm more sure about what things are going to look like 10 years from now than I am about what things are going to look like 2 years from now. And that's how you get an inverted yield curve. But so it is an important thing to think about, right? Weighing the difference between, okay, so if I invest for 2 years, I get less of a return, but I'm locked in longer. Because 6 months from now, yeah, you're going to get a 5.25 versus a 5. But 6 months from now, rates might be lower. So you have what's called reinvestment risk. You have to reinvest the dollars at a lower rate. So sorry, I know that's off on a tangent, but I do think it's related because, the next step of, your question is the Fed raising interest rates. Is that really what's causing inflation to come down? Probably not, right? What started inflation in the first place? We locked down every single economy in the world. And then we just basically opened them all up again. And everybody went from buying very specific things to going back to buying everything, staying in hotels, taking cruises, all kinds of things like that. So, of course, prices shot back up. It was a shock to the system. And now things are, to your point, one of my favorite terms is reversion to the mean, because it just happens in almost everything in the world. things will revert to the mean. And so it raises the question, if the Fed raising interest rates isn't what's bringing inflation down, what is it going to do? And that's the concern now, is that it's hurting employers. They're laying people off. This is the second week in a row of much higher than expected jobless claims that came out yesterday morning. And so it raises the question, are we going to get pushed into a recession? So do we go from, this scenario of way too high inflation into a recession? And it's a conversation we've had quite a bit recently. The big piece for us is who cares, right? There you go. So what Kurt's showing there is the difference between 2-year yields and 10-year yields, and the gray bars are recessions. And so the 2s to 10, I hate predictors and forecasts and all that kind of stuff, but an inverted yield curve has generally been, with varying degrees of accuracy and timing, a pretty good forecaster of a recession. But the other chart that I didn't get around to sending across to you is how do stocks behave before, during, and after recessions. And those things become very difficult to time. And it varies. It depends very much on the recession itself. Maybe I'll dig it up and send it over to you if you want to post it to anything you're doing after the fact. But some recessions, stocks go up a lot. Some recessions, stocks go down a lot. Some recessions. So basically what we concluded was the more stocks go down before the recession, the better stock returns will be at the tail end of and coming out of the recession. The more mediocre or higher the returns of the market are before the recession, the worst stock returns are in during the recession. So sorry for the rant. I think I covered 25 different topics in that ramble, but
no, it's good.
I do think it's important to think about, if the Fed raising interest rates isn't really what's causing inflation to come down, what is it going to cause?
So a lot of things we talk about in the show is, and I'll kind of touch on things some of that Tim said, because what he said is really important. If you think about the rate of inflation, and I'm going out on a limb here, I'm not getting a lot of broad-based support from really anybody in the economics industry, not from mainstream media, not from the institutions, and not from the gold bug crowd, which would typically, I mention it because right now they're kind of they're in heaven, because this is like, hey, the world's ending and they're right. People like to feel like they're right. So here's the thing, okay? We've had low inflation for the last basically 20 years, up until a few years ago. So we had low inflation. And there are many reasons why inflation happens. One of the reasons it happens is printing of money. Everybody says that is correct. However, is it really true enough to move the needle? And that's a big question, right? And I'll get back into that. So one way is to print money. Everybody says that, absolutely true, but not always, and not to the degree that people expect. Another thing that impacts inflation is the globalization trend. The globalization trend was enormous for the early 2000s, late 90s, where basically we outsourced a lot of our labor, a lot of our manufacturing to other countries in Asia that were much, much cheaper. So basically what we did is, let's say it cost $10 to produce a widget, in the 80s, and then we outsourced it to Asia. Now it costs $2 to produce a widget. We just outsourced our inflation to them. So they were getting, if you look at China, they had like 7, 8, 9% inflation every year, because we were outsourcing our inflation to them. And it helped their economy grow, and they become wealthier and all that. But the point is we didn't see the inflation, so the Fed could print money and it didn't matter, because we were outsourcing our inflation. Now, if you saw that the inflation wasn't all that high, you realize the impact of printing money actually was, right? And so if you look at an example like, the early, like 2008, 9, 10, 11, you look at that period, wow, they printed lots of money. We should have had skyrocketing inflation, but we didn't. We had really low inflation. So obviously, printing money didn't have the impact that people thought. And you might say, well, yeah, but in 2020, they printed tons of money. Yeah, they did. And did that lead to inflation? Don't know, right? Like there's correlation, there's causation, right? Correlation is it could have. I would argue that it probably didn't. It may have a little bit. I would say probably the most impact it's had was giving money to the people. You give people 2 grand, 5 grand, $1 million, or depending if you have a business, you're giving people cash, they're going to spend it. Absolutely, that helped cause inflation. Not going to lie to you, that is hard to refute. We can never know because it's a correlation, but I would argue from what I was seeing, it's probably had a strong impact. However, what had a stronger impact than anything is the reshoring of work. So all of the globalization that we've been doing for the last few decades started to reverse after COVID because it had to. We couldn't get anything from Asia. We couldn't get anything from anywhere because the shipping was stopped and COVID and all that. So manufacturing started to convert back to the US and Canada and Mexico and all these other countries, Vietnam, India. Biden was just talking to Modi about it. And they're going to give more jobs to them. So the point is they're diversifying away from China because China's a problem, right? They're becoming wealthier, so it's a problem anyway because it's getting more expensive, and they're a problem because we're competing, butting heads in the global dominance. So long term, they're a problem for us economically. So people are diversifying their manufacturing, but that means it's going to cost more. So instead of costing $2 for a widget, you go to India, maybe it costs $4, or Vietnam, or wherever. Well, that's still a lot more than you were paying before, and you have to pass that $2 gain onto the consumer, which means the consumer is going to pay $2 more, which, if it's a $10 item, now it's $12. That's 20% rise. So a lot of the inflation in goods and commodities was due to this part, the reshoring or the mixing up of the supply chain. In my opinion, that is where most of the inflation came from. And when that gets fixed, the inflation is going to moderate. Now, if you look at the rate of inflation over time, it's gone up and it's gone down. Well, here's a concept that's really important. Most people look at inflation and they look at it as a static number. Oh, it's 9%, it's 8, now it's 4. Okay, it's 4%. What does that mean? It means it's 4% over last year. Well, if you look at the chart of inflation, if you go back and let me share the screen again for what I was showing you, I can kind of illustrate this. So if you look at the U.S. inflation, here we go. If you look at the U.S. inflation, you'll see it was really low, that spiked up, and now it's coming down. Okay. Now, this is the rate of inflation. This is not the amount of inflation. So if you look at this, you'd notice that 2020 was really low because nobody could get anything, nobody was moving anything, so inflation naturally would have been low. Then it spiked up, late in mid 2022 to like 9.1, I think it was, and then now it's down to 4. Now, the thing to note is 9.1 was an increase of 9.1 over the prior year. Right now, it's a 4% over a year ago, which was right around that 9.1. So naturally, unless it's accelerating or staying the same, it means that it's going to drop precipitously, which means that and I've said this in the show, we could hit a 0% inflation number this year. And it has nothing to do with the fact that prices aren't high. Prices are still high, and they're going to remain high, and people's wages haven't gone up to compensate for the adjustments. Inflation might have been 20%, where your wages didn't go up 20%, which means you're now poorer. You now have less money to buy the same amount of goods. So the fact that we could have a 0 or negative inflation print by the end of the year, all that means is the prices are a little bit higher. They're the same, where they were last year, but your wages haven't caught up. So the challenge that people have is they think, oh, this is fine, we'll go back to normal. Things are still expensive because we went through this inflation bump. The things are still more expensive. So unless wages go up to meet that, you're still behind. And you're going to feel behind. It's going to feel like you still have inflation, even if you don't. So all of this ties into the fact that you have to understand the numbers and what it means. How you feel is a very different thing than these numbers. Because you're going to feel like things are still expensive. Because they are. That price is not going down. I can assure you it's going to be a long time before prices go down if they do at all. And if we hit deflation like Japan did, that would be in some ways a great thing, in some ways a really terrible thing. But one thing that's going to be good for is going to be good for cash or fixed income. So what Tim said, and I'm going to mention this and then head it back to him. If you look at the graph, the chart I shared with you on the screen, the Treasury yield curve, the red being today, it's inverted, which means on the short end you get more rates than the long end, which means you're better off buying the short end of the curve. Now, what this curve basically means is it's predicting the future. It's predicting that in a year's time, it's still going to be 5.25% yield. And in 30 years' time, it's probably going to be around 4%. This is a prediction model of what the market is predicting that interest rates are going to be. Now, obviously, it can't be accurate because who knows? It's a guess. But normally, your time value of money is it's more important to buy longer out in the curve if things are normal because you're going to get a better yield, right? So if rates are declining, you want to be on the far end of the curve. If rates are or if they're climbing, then you want to be in the short end of the curve, which is where we've been, right? Short end of the curve, it's paying the best. That's where you want to be because if rates go higher, you're going to get stuck. And you don't want to get stuck with a 5% if you can get a 10% in the future. So the interest rate environment, and I want to bring up this other thing, the unemployment rate, real quick, and I'll hand it back to Tim. So if you look at this is looking back at 50 years, somewhere thereabouts. This is the unemployment rate. So if you look back in the 70s, it was like 5%, went up to 6, spiked up to 8 or 9, spiked up to 10. But overall, it's somewhere between 5 and 7.5 historically during most of this period. Then it spiked up after the banking, the Great Recession, or the global financial crisis, and then it went down to like extraordinary lows at 3%, and then it spiked up during COVID. I think we can ignore that because people just weren't working, but now it's down to 3.5%, which is historically as low as it's ever been, at least in the last 50 years. I'm not sure if it's been lower, but no, I think it went a little bit lower in the 50s, but basically as close to where it's ever been. 3.5% is pretty darn low. That's the unemployment rate. Employers can't find employees, which should lead to people raising wages, but they're not because people are still getting laid off. So we have this weird environment, and it's really hard to understand. So we talk about in the show how the 70s was marked by a mass confusion event. People didn't know what was going on. They didn't know about stagflation. They didn't know that high interest rates and high unemployment and low productivity, low GDP, they didn't know that because they hadn't experienced it before. Now we've got another weird environment. We have low unemployment, we have high inflation, we have stagnant economic activity, and you have stock markets which are bouncing around. People just don't understand it, right? Things are not adding up for how they've been working for the last 50 years. So there's mass confusion. Some people think the stock market's going to take off and say, why? Why would it take off? The fundamentals aren't getting better. You still have high inflation. Why would things take off? So you've got this disagreement in the market, right? Some people believe it should be higher. Some people should believe, actually virtually everybody I know believes it should be lower. But that being said, the fact is it should be within this range. And it will be within this range until it's decided as in mass by the markets that the market should be higher or lower. So that's what you should expect is range-bound markets. Even though it's higher now, it could go a little higher. It certainly could go lower, but just understand that the fact that it's range-bound means that there's a disagreement in the markets of where people think it should be. So what are your thoughts, Tim?
Yeah, so I don't know if you have access to your email right now, but I just sent you a graph because I wanted to touch on the wage growth thing because it's something when we do our presentations on COVID, inflation, and the Federal Reserve, it's one of the big things that we talk about as a guy who spent most of my life as a bond guy. The economy was always very important to me. And one of the big things that I think that gets missed a lot when we talk about inflation, right? We all talk about CPI and core CPI and PCE and core PCE because those are the numbers that are basically the outcome, right? So if you're, if you're looking at like what inflation is, those are the numbers that the Federal Reserve is going to look at, PCE and CPI. But the Federal Reserve is, love them or hate them, they're smart people, they're nerds just like us. And so if you've listened to Powell for the last 6 months, he's concerned about inflation, but what he's trying to do is not stem inflation. He's trying to stem what he views as the causes of inflation. And one of the things that I've talked about throughout my entire career is the ECI, which is the Employment Cost Index. It's a very big component of inflation because, right, you think about, look at any company's income statement. The biggest cost for them by far is going to be their SG&A line, their salary, general, and administrative costs, right? So those increases in costs have a huge impact on overall inflation. So I would agree with what you were saying, because it'd be dumb not to, because it's a fact. Wage growth has not kept up with inflation, but wage growth has been moving higher, and you can see, big surprise there, right? At the end of 2020 and up until now, wage growth spiking because, as Kirk just alluded to, employers can't find workers. I have a friend who right up the street owns a bar and restaurant, and he's now closed on Mondays and Tuesdays because he can't find people to come work at his restaurant. So an important piece of that unemployment number, in my opinion, is the labor force participation rate, which is basically nothing more than how many people are counting themselves as part of the workforce. Meaning, if you go and say, well, I'm not even looking for a job anymore, then boom, you're out of the labor force. You're out of the labor force, and so you don't get included in the unemployment number. So if you have less people reporting that they're unemployed, then the unemployment number goes down because the unemployed people is the numerator. And so when you think, the labor force participation rate has been ticking up a little bit, but prior to these most recent ticks up, it was basically at an all-time low. And that's not just people retiring, but it's also people, employers just having a hard time getting people to come back to work. It's been very challenging, and that's been a huge input into inflation. So I just, because you were talking about it anyway, I just wanted to address the fact that employment costs, wages, and Chairman Powell would tell you the same thing over a beer if he drinks beer. I don't know, but he would tell you the same thing. Like, actually, we're looking at inflation, but the main thing we're focusing on is the jobs market. We want higher unemployment. We want lower wage growth. We want those things to cool because inflation will follow with it. And so far, as you can see on that chart, you've seen a little bit of a downtick in wage growth, which that's really what the market's been looking for. Is, yes, the inflation reports are all the attention grabbers, but what the market looks at, on a day-to-day basis is things like this: jobless claims, the JOLTS report, which is the private employment data that comes out from ADP. They're looking at these things to get gauges on what's the Fed going to do next. Because if jobless claims are going up, wage growth is going down, then ideally that end inflation number should be coming down as well. And then that gives everybody a clue that the Federal Reserve, might continue with their pause, or, Kirk, you're probably as familiar as I am with all the predictions earlier this year that we would have rate cuts by the end of the year. And I think
last month, actually.
Yeah, that's pretty much gone out the window now. So this has never not been true. It's always going to be true. I see people posting on social media, this president did this for the stock market, this president did that for the stock market. It's all fine if people want to talk about that stuff. My view, after doing this for 27 years, the Federal Reserve has way more impact on the financial markets than any administration, Congress, anything like that. And so what everybody's looking for is all these little clues: employment, inflation, all of these things, not as an end result, but for what it's going to make the Federal Reserve do or not do. And that's why I think these things take on magnified importance nowadays.
Yeah, I think, your point's really important there because I want to kind of illustrate on this. So you hear a lot in the media like, Biden did this for the economy, Trump did this for the economy, Obama did this for the economy, and I look at it and I just laugh every time I hear it.
Same
Because if you
here.
really think about it, a president does close to zero for the economy. Well, what about Bill Clinton? He had the biggest budget surplus we ever had. Yeah, it was also the tech boom where everybody had extra money. Like it's not the president. The presidents have literally close to zero impact. Now they have some impact, just like anybody, but they have close to zero impact on the economy because that's not their job, right? Their job is in some ways like a CEO. It's a cheerleader. So like Trump, for example, he got that point. Like he was a cheerleader for the U.S. economy. You could love him or hate him. You could argue with whether he did was good or bad. That's not what I'm talking about. Like he got the point of you have to be a cheerleader. In some ways, Bill Clinton, like trying to pick both parties. 'Cause I don't want to be biased here. You look at Bill Clinton. One of the best things he did is said, "I'm going to stay out of the economy." It's like, hey, what do you want to do? Like, I'm going to stay away. I'm going to let it do itself. Like because it was on a roll. So that's one thing I thought he did really well. He just said, "I'm not touching it," even though Al Gore invented the internet. But outside of that, like he didn't do anything, right? And that
wasn't Clinton the one keep it simple, stupid?
I don't remember. My brain's getting a little foggy. That was like over 20 years ago.
Yeah, right.
But it might have been. But the point is the presidents have very little to do with the economy. But you hear it all the time in the news. Oh, he did this, and Obama did this, and Trump did this. It's stupid because they don't even make. I mean, the presidents don't even make laws. Congress does. And if you want to talk about like like a law being helpful, you can give credit or blame to Congress, but even they don't have a huge impact. The biggest impact, as Tim says, is the Fed, because the Fed is basically, if you think about the Fed like this, the Fed, if the market and the economy is an orchestra, the Fed is a conductor. They're saying, they're waving their wands around, like, do this over here, do this over here. Like they're trying to turn the screws and pull the levers. They're trying to make the economy move in a certain way. And, I argue that you can't play God with an economy because the economy is so complex, you can't really understand it. So how are you truly supposed to know what you're supposed to do? That would be like being omniscient or omnipotent in the Fed's case, but omniscient as well, in the case that you know what's best for everybody. And that's not how markets work. Markets work well because you take everybody and aggregate everybody's buying behaviors and you say, this is what's going on. Because everybody is correct. They're all operating in their own self-interest. So ultimately, you will get the best result with that. And somehow we think that one person's going to do it all. So the Fed does influence the market's behavior. That's actually one of their biggest policy tools is talk. Like, oh, we're going to do this. So Tim said at the beginning of the show, the Fed's talking about this week. They're pausing interest rates for now, the Fed funds rate, and they're thinking of two more rate hikes, so another 50 basis points. Well, that might be true. I would argue that that's probably not true. I would argue it's probably going to be no rate hikes or maybe one. If they do one, it'd be just kind of like let's see what happens. The realistic response is somewhere between, as I've been calling for this for the past year and a half, 5 and 5.5% is the range. That is the range that we're going to fall in for where the Fed does. And they're going to take too long to drop it. And the big problem now, and then we're going to wrap it up. I'm just going to illustrate, and we can come back next week and talk about this. The big problem now is if you look at, I'm going to share this screen really quickly, and then we'll kind of wrap it up. And the screen is the Trueflation, which we had Oliver Roos on recently, where you look at their marker of inflation for the past year, and it's just gone down, and it's still going down, right? And they market at 2.4 or somewhere thereabouts. So there's a lot lower. But the point is we could keep going down in inflation. Now, what happens if we have zero or even negative inflation rates and we still have 5% Fed funds rate? Then what happens? Well, the Fed wants to squash inflation, but now you got a deflation problem. But what if the economy and the stock market is still high? What if it's where it is today? Then what do? Do you drop rates so it just goes through the roof and you just have this hyperinflationary stock market? The Fed has a lot of problems they have to deal with. One of their favorite tools is to talk the market up, talk the market down so that it can keep it within range. Because people follow the market. Most market participants look at the Fed and say, what's the Fed saying? Well, the Fed's saying we're trying to slow it down. Sometimes they have an impact, sometimes they don't. But it's important to understand that there are influences like the Fed, which have a much bigger influence than the president or even Congress. I would argue Warren Buffett has a bigger influence on the economy than the president. And he doesn't have any influence personally, but just the fact that he can talk the markets up or down, give the markets confidence, that's a big influence. More than the president, because nobody trusts the president. Nobody thinks they're an economic genius. Warren Buffett, he's at least got a history. People know he's a smart guy. He's got a history of doing smart things. If he says, I believe in the US economy like he did in 2009, the market's going to rally because, hey, Warren Buffett's behind it. He's buying, so I should too. And sometimes that's all it takes to cause a bump. So, Tim, why don't you wrap us up? Where can people find more about you, and a final thought?
Yeah, my final thought would be not to beat a dead horse, but I think presidents can have lots of short-term noise influence on the markets. But what matters to the stock market, right? Anybody that's been doing this for any period of time knows that what matters to stocks is earnings. When you own a stock, you own a piece of a company, you have a claim on a portion of their earnings. What matters is earnings, and interest rates have a huge impact on how well or how much companies are earning, how much net income they're generating. It has a huge impact on them. And that's what the Federal Reserve controls. And that's why they have more control over the financial markets than the president. This is a great discussion. Thanks, as always, for having me, Kirk. Anybody who wants to find out more about what we're doing and how we're doing it differently, www.metricfin.com. All of our contact info is up there. And if it's not clear for what Kirk and I have talked about today, I love talking about these topics. This was, I told Kirk before we jumped on here, like I'm legitimately excited about this conversation. So thanks again for having me, Kirk.
Yeah, thanks for coming on, Tim, sharing your wisdom with us. And that's the show for this week. Thank you again for joining us, Money Tree Investing Podcast. My name is Kirk Chisholm, Wealth Manager of Innovative Advisory Group. We don't just manage your wealth, we make your life better. You can find more about me at innovativewealth.com. And of course, you can find me every week here on the show. Please remember to subscribe to the podcast on the podcast app of your choosing. You can also check out our show at moneytreepodcast.com. On the website, you'll have access to the show notes, resources, and the archive shows. Also, we're now on YouTube, so please check out our YouTube channel. When you're there, please leave a comment and subscribe. Oh, and don't forget, do your own research. This show is for informational use only. We're not telling you what to think, merely how to think about investing. We're also not selling any products or services, so do not consider this advice. If you have any problems with the show, I blame Putin. So please send him an explodable drone or an email. If you're seeking financial advice, talk to an oracle or a fortune teller or maybe just a licensed financial advisor. I'm one, but as I said earlier, I'm not selling anything. But I'm easy to find. Have a great week ahead, and remember, no one will care about your money like you do, so invest in your life.